Welcome to This Week in Money. I'm Phil Mackesy. Today, Marin Katusa on what's driving gas prices. Louis James has a gold update for us. And Craig Alexander looks at BC's economy. We begin with Marin Katusa right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Marin Katusa is Chief Energy Investment Strategist at Casey Research, and he's Senior Editor of the Casey Energy Report. He's online at CaseyResearch.com. Hey, Marin, it's good to talk to you again.
Always a pleasure.
Just back from PDAC in Toronto, and it was kind of a zoo, right?
Well, it was definitely a zoo. They've broken every record on attendance and also the record on the companies presenting. So we had the whole Casey crew there, and on the Sunday we had a lot of our subscribers come by to the Casey Clubhouse, and on the Sunday we had a sold-out Casey short course seminar that was a paid thing through PDAC. So it was a busy week. It was the end of my 2-week trip, so it was a good time to catch up with everybody and see what's cooking in the industry.
Seems to be lots of folks are talking about oil. It's up again. Let's blame it on bad news from Iran. And always good to hear from President Obama on the topic of energy. From yesterday, here's the president. Every year about this time, gas starts spiking up, and everybody starts wondering, how high is it going to go? And he says that he knows there are no quick fixes to the problem. I just hope that he is reading your new energy editorial.
Well, look, Obama first said by 2020, 80% of electricity is going to be generated through green power. Well, Solyndra and all the different facts panning not to be panning out that way. It's political lip service, all right?
Sure.
And what's important to understand is natural gas has never been this cheap, in my lifetime. And what he has to understand is the actual oil being used on a gasoline for your car is declining recently. So what he has to understand is there's so many other factors playing in, such as refineries. And, even though WTI right now is somewhere around $106 US per barrel, I can't emphasize enough to people to be very careful, because it's all about the netbacks. I wrote an article that's free on our website. Every Tuesday I publish something on our Casey Daily Dispatch, and it's all about the differentials. And you look at what's going on in the Bakken right now. The Bakken's getting about $70 for oil. So a lot of people are jumping into these oil companies thinking that because oil's $106, that's what their company's selling the oil for. In the Canadian oil sands, it's as low as $62. So you got to be very, very careful right now and avoid what politicians are saying. Stick to the fundamentals.
Let's talk about the economics of oil. You're talking about the disconnect between the world price and the reasons for that. We'll talk about the refinery situation in a second. But I want to address a pretty common question folks have, which is, hey, if the price of oil is going down, how come I'm paying more at the pump?
Well, exactly. It comes down to, the refinery's costs and the usages and the logistics of it and all that. So taxes are a big part of what you're paying for at the pump. So that's another thing that the governments won't tell you. I'm a Canadian here in Vancouver. The biggest portion of the funding that's going towards public transit comes from the gas. And what people don't realize is it's only getting worse from the government standpoint. So it's easy for a politician to redirect the real issue of higher taxes when it's really, something that they don't want to be talking about. So that's part of the problem is the taxes, part of the problem is the refineries. And the reality is access to that oil. So if you look at the PAD 3, where they're importing oil from Venezuela, that's a heavier oil, they're paying a premium to the WTI, where that same type of oil could be coming from the Canadian oil sands, but the California protesters, all the B-rate actors, they want to protest that pipeline. That pipeline would be equivalent to about twice the oil produced in Iraq right now. So little things like that, they're a victim of their own legislations and policies.
Easy to pick on the Middle East as being one of the sources of the problems here, and for sure it is. There has been nothing but problems in this area for as long as I can remember, and it looks like lately there's more saber rattling going on. But you're pointing out an excellent thing that I never realized until I started reading your stuff. There is a huge problem in oil infrastructure, mostly in the United States, and that's causing fits and starts in the oil business there.
Well, it's changed. You see, you used to be able to import the oil cheaper than what you'd be able to produce it domestically, never mind move it around. But that's changed. If you look at now, I wrote the article in the January about the distribution of oil at a profit from it. But basically you have these pads, and the pad 2 right now is at capacity, where it used to be pad 3 would be exporting to the other pads in the nation, but it's changing because the technologies have changed. You know, America's been so successful with the shale gas and the shale oil that it's been a game changer. Okay, so now the infrastructure has to be placed in. Not only that, infrastructure needs to also be upgraded. A lot of the pipelines that people are, protesting against, what that's going to do is replace the older existing pipelines that have been built when Elvis was rocking out in the late 50s and early 60s.
Yeah.
Something to be very careful of that, the existing infrastructure in the U.S., about a third of it's built before 1970, and that's a ticking time bomb. So these are real important issues to really understand and look at. Another issue, people are talking about the potential to, export Canadian oil sands to Asia. Well, first of all, the pipelines need to be built. You got to first get the natives on side and get the permits to build them. Then the cost advantage, you have to get bigger tankers in. And then there's a problem there. Not every port is built the same. So if you want to get it towards the Vancouver port, they're going to have to dredge that strait. That's another permitting nightmare. So there's a lot of issues. That oil is not the issue. It's getting the oil out is what the issue is.
Now, speaking of distribution, for our friends, our podcast and radio friends who won't have a chance to read the article, tell us how oil moves around North America, because it's fascinating.
Well, it depends which pad you're talking about. Let's say if you're from the Canadian oil sands, you're basically producing it, whether it's an open pit or in situ or SAGD, however you want to call it, and then you add your diluent, you bring down the pipeline capacity, then you take it down to pad 2, and then from there, there's many different forms that it gets the refining. So America's got the greatest refining complex in the world. It can do just over 17 million barrels a day. And what America has correctly anticipated is that we're not running out of oil, but what we are running out of is the light, sweet crude oil, and they've upgraded for the heavier oil, which is the type of oil that comes out of the Canadian oil sands. But unfortunately, there's only so much that Pad 2 can do, so now we're at a surplus. So without the Keystone XL taking it further south, all the way to the Gulf, or what's called Pad 3 in the business, you're getting a much lower price because of the supply and demand issue. Okay? So when I was in Iraq, it's interesting because they had 3 main pipelines. The infrastructure, that's, one $5,000 grenade from a long distance from the mountains takes out that pipeline, and they're trucking out the oil from certain fields, for example, from the Kirkuk field. So it all depends. We have a great infrastructure in the U.S., but it still needs to be upgraded. We still have to improve it. And the interesting thing about what the protesters, when I was on BNN on this debate about it, the Keystone XL pipeline today would provide about twice the oil that the Americans import from Iraq.
Wow. So
think about that. You make your choice. The Americans are calling us, the Canadian oil sands, very dirty. First of all, the bitumen production within California, people forget that California is still a major producing oil for the states, produces more CO2 and pollution than all of the oil sands combined.
Amazing.
So before you come to Canada and tell us that we're dirty, look at your own state first.
Drive around L.A.
Exactly. When you drive through from the airport and on the beach, you see these wells going. From the beach, you can see the offshore platforms. So, all these things are key, but you have to make the decision. Bloody oil or dirty oil?
And one of the things we have to remember also, Marin, that there is a seasonal element here. The refinery problem is also a seasonal problem. A seasonal problem.
Also, on top of the seasonal issues, also upgrading and modifying the refinery. These things always have to be, it's like kind of taking your car into a tune-up, so they have to shut down and also rehab the refinery. So that's another issue that's going on. And with the heavier crudes comes more modifications and more upgrades.
You mentioned the infrastructure. I remember seeing a couple of weeks ago on the internet a chart showing the ages of the oil rigs themselves drilling in the Gulf of Mexico and elsewhere offshore. There's another time bomb waiting to go off.
Well, the Gulf of Mexico disaster in mid-2010 was a good reminder of what's going on. And the sad reality is 1/3 of America's domestic production comes from offshore wells. And, people don't want the shale oil. You look at the movies like Gasland, all the issues. Reality is where are you going to get it? There's a lot of oil in America, but you look at Alaska, that's an issue. Wherever it seems to be some sort of potential, you got the protesters out there. So, the reality is you have to go unconventional, or if you are going conventional, you're probably going deeper offshore.
You are saying that there is good news on the horizon for all this. There's some good news in this story.
Without a doubt. If you're an investor, there's interesting. We wrote an article, and we've had huge gains in our newsletter on service companies. As the technologies are changing, these companies have to go towards higher horsepower, which companies can do multi-frac horizontals longer, and there's potentials there. There's potentials if you invest in the companies that have the management teams who can find these big shale deposits. So wherever there's a crisis, an opportunity follows very closely behind.
Speaking of opportunities, Marin, tell me how I can get involved in the 2012 energy forecast that you guys put out.
Sure. Just go to our website, kcresearch.com, and we have a load of reports and issues there. You can try out a 3-month trial at no cost, and if you don't like it, if it's not for you, that's fine. But every Tuesday we publish a free article, so it's a no-risk trial, so it's up to you if you want to try it out.
Got a couple of other oil items in the news this week. Today, Syria's deputy oil minister has defected, and it got me thinking, I don't hear much about Syria and oil production. You're familiar with the Middle East generally. Where does Syria rate in oil production and reserves?
It's not even in the top 5.
Okay.
So it's more of a geopolitical issue. It's kind of like where when Libya had all its issues. That's like kind of saying the Canadian oil sands went out. It's not a major producer. It's important, but it's not even in the top 10 for reserves. When you look at it, it's nowhere near Iraq.
Okay.
So, but because of its location, it's important.
Now, Iraq is one place you have been. They started pumping oil this week from a new terminal there. First of 4, they figure it'll double Iraq's oil production in the next few years, and long-term, their goal is to be up there with the Saudis. That's got to be encouraging.
Well, yes and no. They've been saying this for a long time. They have not hit their goals. If you recall, going back about 8 years ago, the expectation was taking it from 1 to 6 million barrels, and they're nowhere near that. Not only are the wells getting more expensive, but the output, the production rates of the wells have not been as high or as economic as people hope for.
Okay.
So not only is it getting deeper, higher cost, but there's still a lot of issues: manpower, cost overruns, infrastructure issues. So it's easy to get excited about it.
Yeah.
But, the past results have been very poor.
And it's still a pretty crazy place to do business.
Oh, without a doubt.
Yeah.
It's still, there's a lot of issues going on there still.
It's worse than Toronto.
Almost.
Finally, a reminder on what a tough business the oil business is. ExxonMobil says today its oil and gas output will be 3% less than last year, and wham, its shares fall 1%. Now, we talked earlier about ExxonMobil. They are the big dog in the oil business, and that's probably why. But what does it mean?
Wow, that's very, very, very important. But see, there's another opportunity there. There's the world's largest market cap publicly traded oil company on the planet that just lost over 1% of their value in one day. And this is a coming trend. This is an inflection point coming. And the Exxon Mobils of the world, what they're going to do to replace their reserves and production is acquire other companies.
Mm-hmm.
See, what the general public doesn't realize is the Exxon Mobils, the Chevrons, the Shells, the BPs, they do not own the largest deposits anymore. They're not the big producers.
Okay.
In town. They were part of the old Seven Sisters, but the new Seven Sisters are Saudi Aramco. It's Venezuela.
The mid-tier companies, right?
The national-owned companies.
Yeah.
They're owned by Chavez. They're owned by the sheiks. They're the ones that own all of the big deposits because they've nationalized them from the big publicly traded companies. So it's very important to understand that there's a major opportunity here because the Exxons and BPs and Shells, they have to go and acquire production and reserves.
Marin Katusa is Chief Energy Investment Strategist at Casey Research. We're always glad to have him here on This Week in Money. Marin, thanks for your time.
Always a pleasure.
Coming up, Louis James on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Louis James is Chief Metals and Mining Strategist and Senior Editor of the International Speculator and Casey Investment Alert. He is online at caseyresearch.com. Louis, that's quite a business card you got there.
Yeah, it keeps me busy.
Welcome to This Week in Money, Louis.
Thank you very much.
You are just back from the PDAC, the Prospectors and Developers Association of Canada Conference in Toronto, the world's largest mining gathering this week. How did that go?
It was, as usual, a madhouse. It's interesting, though, because the numbers reported are that this was a new record, well over 30,000 this time, up over 27,000 last year. But it didn't feel crazier than last year. It seemed as busy. Maybe it was just that the mood was a little more subdued. Interesting times.
Why would the mood be subdued? I mean, gold is up, silver's up, everything's looking good. Well, what's the problem?
Well, it's funny that you put it that way. A lot of people don't feel that it's up. They forget that a year ago, gold was at $1,400.
Yeah.
And in fact, a week after PDAC, it had dropped below to $1,395. And here we are still maintaining prices that just a couple years ago were a dream for miners. But people are short-sighted. They often have a what have you done for me lately kind of approach. Investors are no exception. And the big kerfuffle last week, the $100 loss in one intraday period, really shook some people up. That's just chatter. Anybody experienced knows that. But people lose sight of the long term very easily.
Name of the game, of course, is funding. A lot of these people are looking for funding, and Bloomberg saying that that's going to be a problem for a lot of folks this year.
Well, it is and it isn't. In a way, this is market. What should we say? Or maybe we shouldn't say it nicely. The predatory aspect of the market here, showing that it is actually valuable. It's separating the wheat from the chaff. The good people, the tried and true experienced management teams with good projects, they're being able to raise money. You can see money right now being raised with no warrant even, or just a half warrant for a shorter period of time. And other people, less tried and true, less proven, are having much more trouble. There's been news of financings canceled and things. So yeah, the money isn't out there as easily as it has been in times past, and that has interesting implications. But it is out there for the right people. So the exploration's not going to stop. And if you're in with a good company, and good projects, good people, they will move forward.
We're talking to Louis James from caseyresearch.com here on This Week in Money. One of the things that we've been talking about for the past little while, Louis, the disconnect between gold prices and gold producers. Gold producers obviously lagging. Here's a stat here. Gold more than doubled in the past 5 years, while the Huey has only climbed about 50% or so. Why is that?
Well, there's a legacy of underperformance in that issue. And to really move the majors in a big way, we need to have a broader participation of markets. A little junior that's trading at a few $1 million of market cap, it discovers something and it can go 10 to 1. To move the dial on the big companies, you need a lot more volume, a lot more people in there. and the costs have risen with the price of the underlying commodities. So really, until recently, we haven't seen consecutive quarters of record profits. I think as that continues, and I do believe the high price of these commodities, particularly precious metals, has outstripped the increase in prices that the producers are paying their costs, so that we should see more records. We are seeing more records. But, a quarter or two is not going to impress Wall Street and mainstream investors very much in the way that would really bring droves of new investors into play. I think that's ahead.
Okay. Let's bring ourselves up to date with what's happening with gold lately. It's bouncing back with oil and with stocks today. And, of course, we've had some good news from Greece, and Ben Bernanke kept his mouth shut this week, which kind of helped things all around.
Yeah, no, it's quite interesting, though really the fluctuations in the last couple of weeks have been, in a way, the opposite of what they should have been. Trouble in Greece, trouble in Europe, looks bullish for the dollar. Bullish for the dollar makes people sell gold because gold is priced in dollars, and generally people with I believe, an outdated mindset see, what's good for the dollar is bad for gold. But this is not true. This is old thinking. And if you have economic trouble in the global economy, it may make the dollar win the race to the bottom for a day or for a week. The dollar hasn't actually gotten stronger than it was 2 weeks ago. It's only looking better than the euro. That's not a basis for dumping gold. That's almost literally insane. That's crazy. There's more trouble in the world, so you're going to dump gold? That makes no sense. So, yeah, these fluctuations are tremendous buying opportunities. When something goes on sale for the wrong reason, you have to be a bit of a contrarian. You have to be willing to have confidence in your own judgment and say, I'm right, everybody else is wrong, and buy the dips. And if you had done that last week, you'd have made a significant short-term return.
What about this research report here from UBS? They say the possibility of QE3 is going to be the key to determining what happens next with gold. You think that's true?
Yes and no.
Okay.
Clearly, when the government signal massive new liquidity injections, that's good for commodities, and you can see that. And so when Bernanke didn't say anything about QE3 or something that looked like QE3, then gold sold off that day. But again, what the talking heads say and what actually happens are two different things. Really, the governments are between the proverbial rock and the hard place. They have no choice, especially this is election year. They cannot allow the appearance of recovery here to falter in any way, and they will do whatever they have to do. And whether they call it quantitative easing, though, is another matter. There may not be any big announcement, but there's ways that they can massage these things. So an example would be the recent sort of incestuous lending between the U.S. and Europe, helping each other out with their mutual bailouts. We don't call this quantitative easing, but it's still a massive amount of basically printing money out of thin air.
We are talking to Louis James from Casey Research here on This Week in Money. What do you look at the gold ETFs? They are a huge force in the market, holding almost $130 billion worth of gold. That has to affect what's going on, right?
Well, there's an interesting argument has been made there that one reason why the gold companies haven't performed as well as gold on a broad basis is because of the ETF.
Yeah. That
the ETF is eating up the consumer demand for gold stocks. I think this is actually incorrect. There is something to it. Obviously, it's easy for people who want to play gold to buy the ETF, and it's very liquid. It's like buying gold itself, but on your day trading account with E-Trade or whatever.
Okay.
So yes, there's something there, but you have to remember that the reasons to own gold are very different from the reasons to speculate in gold stocks, and broadly speaking, the metals and commodities along these lines. You buy gold for prudence. You buy gold because you're worried. Gold is the ultimate safe haven, right? But you don't buy little junior mining stocks for prudence or for safety. You buy them for their speculative upside. You buy a company that has an almost insignificant market cap, and it discovers a multi-billion-dollar deposit, and the thing can literally go 100 to 1. That actually happens in our sector. That's why people buy the stocks, and you're not getting that from the ETF. So that hasn't changed, and I do expect these commodity-driven stocks to deliver as they have in the past as we get to the real mania phase, which has not happened. These people who say gold was in a bubble, I believe, are missing the the overall situation here.
Gold dropping below its 200-day moving average this weekend. Perfect timing here. Jeff Clark is writing at Casey Research. Time to accumulate gold and silver, and it makes a lot of sense.
It does. His analysis in the most recent issue of our free newsletter, we have a free daily newsletter, actually, but every Monday it focuses on metals and mining. And Jeff did something that, frankly, I never would have done. He looked at the chatter, and we call the daily fluctuations chatter because they're generally meaningless. And it's funny, if you ask our boss, Doug Casey, on any given day, he may or may not know the price of gold because he really doesn't look at the daily fluctuations. He looks at trends, he places his bets, and he waits until he's right. So to look at the daily chatter was a strange thing for us to do, but what Jeff found was that the pattern in the chatter was visible as you approach the big manias in the markets. You can see the chatter increasing. You can see the volatility increasing, in other words. And placing things in that context, and of course history never repeats exactly, but still, looking back at the pattern of chatter leading up to the spike in 1980 in gold and silver, you can see that we're at nothing near those levels. We're also, the big fluctuations in the last week are not the biggest fluctuations in this cycle either, by any stretch of the imagination. So much ado, not about nothing, but much ado about really a small bump in the road.
As you touched on earlier, Louis, one of the things we really have to focus on is what gold does for us as compared to what our fiat currency does. Here, we've got a great stat here from Jeff. Both the U.S. and Canadian dollar have lost about a quarter of their purchasing power in just the last 10, 12 years.
Yes, it's quite striking. And if you look at the comparisons, if you look at inflation-adjusted terms, gold still hasn't beaten its 1980 spike, and you look at how much the fiat currencies have lost since 1980, and it's kind of depressing. That's not just looking back 100 years or to historical records, but just in a generation, what's happened to the fiat currencies. It's you wouldn't have believed it if you hadn't lived through it.
Mm-hmm. Now, even Doug Casey doesn't have a crystal ball. He can't look forward into the gold market. So we're just going to kind of guess what you see happening. Obviously, with all the news and the headlines, it's difficult to believe that gold will go down. What do you see going forward in the near term for gold and silver?
If things continue as they're going, I would expect to see more or less gold trading sideways, the metals trading sideways. There's enough fright in the world, and ultimately, I don't see gold driven by supply and demand. It is not an industrial metal. It's a barometer of fear in the world, and there is enough fear that's been generated by the great calamities that we've seen in recent times that's just not going away very quickly. So even if things continue seemingly improving, they've just announced the New Deal in Greece, so yay, Europe is saved, everything is all fine. In the United States, there are signs of recovery, unemployment is down, Obama has saved us all. It's happy days again. Even if that were true, gold is not going to go back to $300 an ounce in a few months.
Yeah.
It's just too much has happened for people to forget their fear, for the sphincters to unclench, and things to go back to the happy train that we were on before. But of course, things never continue as they expect. There's volatility in the Middle East. Who knows when the fuse will actually hit the keg in South Africa?
Yeah.
There's signs of China potentially being in trouble. The new projection of 7.5% GDP growth, their new target in China, that may not sound like a big deal. The 7.5% GDP growth is huge compared to Western economies. But my sources in China tell me that anything less than about 8% can lead to serious social unrest in that country. 7.5% is their lowest target, and I don't even know how long.
So for them, that's pessimistic.
Stuff.
Yeah, for them, that's pessimistic.
Yes, it is. It is. It's very pessimistic, and of course, you don't hear about all the riots and problems that they have because this is state-controlled media. But if you know people in China, you know these things are happening. So again, there's plenty of cause for concern. And with that sort of thing, I don't see the fear barometer of gold going anywhere substantially lower in any near term. And of course, the things that the governments of the world have been doing to paper over the problems and to try to reflate the economies are ultimately bullish for all commodities, including gold. So, I am a bull. The worst case scenario I can see is actually if Doug Casey is right and there is another big kerfuffle, if the other half of the W has not actually been postponed that long, and you get another 2008 style crash that's both deeper and longer lasting, everything gets hit, right? People need cash.
Yeah.
They get their margin calls, the funds get their redemptions, and so on. So even gold would take it on the chin under that circumstance, but only short term. As people hit the bid on anything they can sell, they will sell gold simply because there are buyers, whereas there are not buyers for the condos they foolishly just bought into or whatever. If that happens, that's almost the best possible scenario for newcomers to the market, because you can see lower prices than we've seen in a long time. It's maybe the last chance to back up the truck for both the metals themselves and the stocks.
Louis James is senior editor of the International Speculator and Casey Investment Alert. He's online at caseyresearch.com. Louis, thanks for this.
Sure, you're very welcome. Pleasure to be here.
After the break, Craig Alexander on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
Craig Alexander is Senior Vice President and Chief Economist at TD Bank Financial Group. Craig, welcome to This Week in Money.
Oh, it's my pleasure.
Good to have you here on the West Coast. You were talking to the Vancouver Board of Trade today. Is the glass half empty or is it half full?
Well, I think we have to be pragmatic. The reality is that we continue to live in a very risk-filled economic and financial environment, but the main message I have is that the BC economy should continue to advance at a relatively solid pace. I think what we're going to really see is moderate economic growth, about the same as the national average, probably slightly above 2% over the next couple of years. I think what we're really going to see from a composition point of view is I think that there's scope for business investment to be probably the strongest contributor to economic growth. I think exports will continue to grow, although I don't think the export environment is going to be particularly booming. But I think that the Canadian dollar remaining at close to par is going to remain a competitive challenge for a lot of manufacturers. But I think that generally speaking, the commodity sector will outperform on the export front. I think the real challenge from a point of view of economic growth is the fact that households have taken on a lot of debt in recent years. We can't really expect the consumer to be the engine of economic growth. I think in general what we're going to see is gradual employment gains leading to slightly lower unemployment, but that doesn't create an environment where we're going to have a booming consumer and strong consumer spending, even though I do think interest rates are going to remain at very low levels for an extended period of time. So I think overall what we're talking about is consumer spending running in line with income growth. So after you strip off inflation, you're really talking about a consumer that's contributing to about a 2% overall growth rate.
Okay.
So it's to your point, it's really how you approach that forecast is really whether you're glass half empty or half full.
Yeah.
The glass half empty is it's not booming economic growth, but the glass half full is it's not bad.
Now, for our friends who are in other parts of the world, BC is a largely export-driven economy, and we are pretty heavily dependent on the U.S. and on China.
Yeah, and in my conversation with the Board of Trade, I think one of the challenges is that I end up spending probably two-thirds of the presentation talking about what's going on in the external environment, because that's where the big risks are. When we talk about global financial risks, the European fiscal crisis is an ongoing concern, and how it plays out will have a very big impact on how Canadian financial markets do. The Chinese economy is in the process of slowing down. I actually think China will have a soft landing. I don't expect a recession in China, but I do think economic growth is going to slow this year to below 8%, and then I think it'll start to pick up again next year. And the U.S. economy continues to be the major export market for BC. And quite frankly, the prospects for the U.S. economy are that it's only going to be delivering modest to moderate growth. The U.S. still faces enormous headwinds particularly from the weakness in the housing market. But we're also heading into an environment where there's a lot of uncertainty related to the drag on the economy from fiscal policy. There's a lot of government programs that were put in place to support the U.S. economy during the recession that are going to expire at the end of this year. And I think the big concern from a Canadian perspective is that what we're seeing in Washington today is complete gridlock. Now, I think that the gridlock should abate to some extent after the presidential election in November, but there's still a lot of uncertainty as to what's going to happen to fiscal policy in the United States. So this is why, for example, when the BC government put its forecast together, I think it was a very sensible way of dealing with the economic assumptions, and that was take a consensus of the economic forecasters out there and then scale it down just in case things aren't as favorable as we might hope.
We're talking to Craig Alexander from TD Bank Financial here on This Week in Money. One of the big factors, though, we have to think about, of course, is consumer spending, and you're saying that's going to be fairly modest this year.
Yeah, when we look at the outlook, I think that what we're going to find is that employment growth in the coming year is probably going to be rising at about a 1 to 1.5% pace. I think that'll lead to the unemployment rate in BC gradually coming down, but only by a few tenths of a percentage point, which means that the recession, the unemployment rate will still be higher than it was before the recession, but it is, a gradual improvement. I think one of the big challenges that we've had over the last year or so is that after we take off inflation, personal income growth has been very weak. In fact, last year, wages and salaries only rose in line with inflation. So, after the rising cost of living, consumers really didn't have a lot more money. And then we have a consumer that's saddled with an awful lot of debt. So when you think about the economic fundamentals, I don't think there's going to be a problem on the consumer spending front, but I think it's going to be an environment where the consumer is relatively tight-fisted with their money. I think that in the retail space, I think this means that we're going to see a continuation of a very hyper-competitive marketplace. I think retailers are going to have to continue to consider how they discount their products in order to make the sales. So I do think it's going to be not a terrible year for retailers, but a continued challenging one. I think that overall retail spending probably in the coming year in BC should rise by about 4%. So if you strip off inflation, that's about a 2% increase in the volume of sales.
We are talking to Craig Alexander from TD Bank Financial here on This Week in Money. Let's talk real estate for a moment. Are you fainting from the real estate prices out here?
I have to be honest. I mean, I'm an economic forecaster. I've been forecasting real estate markets for a long period of time, and quite frankly, it is very difficult to make a good prediction of what's going to happen to real estate, particularly in the Vancouver marketplace. When we look at affordability has deteriorated significantly as home prices have risen. When we look at the amount of money, in terms of affordability of homes, it's the worst in the country. But what we get is a lot of anecdotal evidence that there's a lot of foreign buying in the marketplace, and that might be having an impact. We also don't have numbers on the amount of purchases that are being done for investment or speculative purposes.
Okay.
So I guess my point is that there's some key elements about the real estate market that could be having a big influence right now that we don't actually have quantified numbers on. You always have to be careful when you're taking anecdotal stories and turning them into generalized comments about the market as a whole. I think this is something that the Bank of Canada, CMHC, and other government bodies are working on. They're trying to put together surveys to give us the information so we can make a more educated assessment of what's happening in the market. I do think we have to recognize that given the extent of run-up in prices that we've seen, that the market is very vulnerable to a correction. I think, though, the correction needs a catalyst. And the two main catalysts for a real estate correction would be either sharply higher interest rates or significantly higher unemployment. And I don't see either of those outcomes in the near term. The Bank of Canada isn't likely to start raising rates until the second half of 2013. There's a limit to what the Bank of Canada can do with interest rates when the Federal Reserve is on hold. And the Fed has told us that they don't expect to raise interest rates until late 2014 at the earliest. Mm-hmm. So I don't see an interest rate shock coming that would cause a problem in the housing market. The other major catalyst would be a sharp increase in unemployment. Well, unless the global economy runs into a problem, unless Europe loses control over their fiscal crisis, or unless China has a really hard landing, I don't actually see the ingredients or the elements for a recession in Canada. So I don't see an environment where we would have rapidly rising unemployment. So without that catalyst, the assumption has to be that what we'll see is a gradual cooling in the marketplace. And so in my forecast, I have home prices in Vancouver coming down by about 3% this year, down 5% next year. But markets outside of Vancouver are actually being just pretty flat because they don't show the same degree of weakness in affordability.
Now, whatever happens, we are most likely not going to see the same kind of housing problem that happened in the States.
Well, I think that the core difference between Canada and the United States isn't the amount of debt that's been taken on, but the quality of that debt. In other words, lenders in Canada have been more prudent about their lending behavior. 90% plus of the mortgages that are done are income tested rigorously. The 10% that are deemed to be sort of like equity lending are actually still go through a very rigorous process. When we look at the United States, one of the core challenges was that they had a rapid growth in what was called the subprime market. These are high-risk mortgages. In Canada, the subprime market is probably well less than 5%. So in other words, the quality of the loans that have been made have been much better than elsewhere, which means that the risks associated with those loans are much lower. We've done a lot of modeling around what would happen if we had a return of interest rates to what would be sort of more normal levels, so something like a 2.5 percentage point increase in rates. And our assessment is that perhaps about 9% of Canadian households would find that more than 40% of their income would be going to service their debt. And when you get past 40%, that's usually where the warning lights start going off. So we're not talking about the majority of Canadians, but we are talking about a significant minority. We're talking about perhaps 1 million Canadian households having difficulty when interest rates go back to normal levels. So, I don't think we should be complacent about the risks, but we also shouldn't overemphasize them. We should understand that the true nature of the risks that are out there.
More with Craig Alexander next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're talking to Craig Alexander from TD Bank Financial Group. Here on This Week in Money, gas prices very much on our minds these days. Here in Vancouver, the average is about $1.37, which fits kind of right in the middle of your proposed midsummer range of $1.30 to $1.50. We're getting there, are we not?
Yeah, and I think that is the new risk that's out there. That's the new element. What's interesting is when we were heading into this year, when I was doing my 2012 forecast, the big risks were related to Europe and the United States and whether China would have a soft landing. And in fact, as we look at what's happened, the risks that we identified at the start of this year have actually been diminishing. We've actually seen some progress in Europe. They're not out of the woods, but it's progressing. The U.S. economy seems to be doing better. And I'm still pretty confident about a soft landing in China. But the risk that we didn't see was increased tensions with Iran. Mm-hmm. And, you cannot predict what will happen with Middle East politics. But it feels very uncomfortable when you look at when you pick up the newspaper and you hear a lot of speculation about possible strikes against Iran to to derail their nuclear program. It's a very uncomfortable environment. If you take out the political risk premium right now in the cost of crude oil, the price of crude would probably be in the $90-$95 range. So you can see the impact that Middle East concerns have had. And quite frankly, the risk is that if they escalate, the price of crude oil would go materially higher than it is today. And it's at current levels, if it went up significantly, I think it would start to have a very significant dampening effect on global economic growth. So it's a core risk that's out there. I think the more likely scenario is a continued level of tension, continued tensions in the Middle East. And if that was to transpire, then I think crude oil prices will remain pretty close to current levels in the near term, might pull back a little bit later. But quite frankly, from an economic point of view, it will have a dampening effect in terms of knocking a few tenths of a point off of U.S. economic growth. In Canada, it's a bit of a mixed bag because Canada is a net oil exporting country. So in actual fact, higher oil prices are good for the Canadian economy. It actually leads to higher economic growth. Sure. But it creates winners and losers across the country. It basically, provinces that have oil benefit provinces that don't, or are net importers of oil. They tend to lose in this environment, so it creates more regional differences. And
anybody trying to fill up at the pump obviously is a loser here as well, right?
Well, across Canada, it's a negative for consumer spending, no question about it. After people fill up their cars, they have less money for other goods and services, and that shows up into weaker retail spending. But the offset is that the oil and gas sector actually creates more jobs, invests more, and you have more economic activity in certain provinces. So, in a completely dispassionate, economist way, the impact of higher oil prices are a net positive on the Canadian economy. But I think you always want to be sensitive to the fact that there are a lot of people and groups that actually suffer from higher oil prices.
Craig Alexander is Senior Vice President and Chief Economist at TD Bank Financial Group. He spoke to us today from Vancouver. Craig, thanks for your time.
Oh, it was my pleasure.
Our thanks to our guests, Marin Katusa, Louis James, and Craig Alexander. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.